So do you often touch IPOs then? Like, Monty mentioned ARM earlier. That's going to be over your 2 billion mark, or is that one where are you going to be more confident because of your background to step into a technology IPO like that? Or are you going to kind of just let that play out for a bit typically?
I was going to say one thing to Monty's point. Symbotic, Monty, the only reason I bet big on Symbotic was because I have been at Amazon doing the robotics associated with inbounding, start shipping, automated packaging, and pack pick ship, right? So I knew that something that required that amount of labor, if Symbotic can cut that down by 30%, and it did, and they had a huge backlog of earnings that they had already banked in from Walmart and Target. So that's one of the reasons I bet big on Symbotic. But back to the question you asked me, Josh, uh, IPOs in general, I've changed my view over the last 7 years or so. Um, ARM, I know it very well as a company, well enough to have been staying completely on the sidelines and expecting it to go down to 40 in about 6 months or even lower. In the long term, I'm a big believer that valuations play themselves out. They matter a lot. So ARM is just, in my mind, one person's opinion, ridiculously expensive. It should actually be a $26 to $32 stock, but a combination of no IPOs at all for the last, what, 6, 8 months, or no big IPOs for the last 6, 8 months. Kenvue is there, Kindle is
Absolutely.
there, but there is lack of supply, so the demand went up. Even with Instacart, and the same with Klaviyo, I believe they're very good companies, both of them. Klaviyo more so than Instacart, and even more so than ARM. But the valuations are just too rich for me. ARM, I would buy if ARM was in the 26, 32 range. I would buy Instacart if it was much, much lower in the 20 range, which is nearly 30% off of where it is right now. And Klaviyo, I think, is reasonably priced given its 62% growth year over year on revenue. It's a profitable company, very little spend relative to their peers on sales and marketing. So they have very good leverage, good, strong gross margins. 10 billion for a company like that, 9 point something billion is where they ended up, is reasonable. But I still think that there is a chance after, give it about 6 months, when the option and when the expiration happens for all of the insiders to start selling, I wouldn't be surprised if it goes down to the 6-7 billion range.
I'm not familiar. So for my radar for the IPOs was ARM, Cart, and then Birkenstock. I'm not even familiar with Klaviyo. Can you talk about what they do a little bit?
KVYO is the ticker symbol.
Okay.
KVYO. So in the CRM space, so if you look at it from the software as a service and cloud general space, there are two kinds of companies. There are infrastructure companies, like, for example, Datadog, Snowflake, Net, which is Cloudflare. And then there are applications companies like HubSpot, Salesforce, Klaviyo, etc. In the CRM space within the applications area, there are quite a few competitive companies that do fairly well, that are all in the same general space, kind of compete with each other, but the market is so big that they all do well. So Freshdesk, Klaviyo, Sprout Social, CXM, and CRM, they all kind of compete with each other at a very high level. But they're all in different spaces. Klaviyo focuses on Shopify customers. As a big bonus for them is that Shopify has invested in the company and also has a percentage stake in Klaviyo. So Klaviyo provides you with email marketing, text marketing solutions. If you're a small to medium-sized Shopify store owner and you want to be able to engage with your customers, to be able to provide ongoing promotions to help you with increasing your business, Klaviyo is a very simple, easy to use solution. There's a company that Intuit purchased a few years ago called MailChimp. Have you heard of MailChimp?
Yeah, absolutely.
So this is like a MailChimp, but focused on Shopify users. Built in 2012 is when they got started. They grew with Shopify significantly. They have a ton of customers, in the hundreds of thousands of customers. Profitable company. And since they've raised money in Series B, they've never spent that money. They still have all that cash lying in the balance sheet. Plus, they raised some more in the IPO. And the founder, who's an ex Harvard student, I think he started it when he was, I think he may have left Harvard and got out of it, and that's when he started it. Has run a very efficient sales and marketing machine. They've acquired customers in a very inexpensive fashion, very similar to a HubSpot.
Oh, so when you're evaluating a company like that, what is there a moat that you're looking for that also sets them apart from their competition?
I
Is there
think to
what?
be moat in the early stages of the company has to come primarily from technology. In the later stages of the company, for example, when the company is doing, close to about 5 billion in revenue, especially if it's a software company or a technology company, that's when you've got to look for other moats. But in the software space, moat comes from a combination of technology, unique capabilities, maybe patents to a certain extent, but also a lot of locked in customers, right? So anybody can have a partnership with Shopify, and they would probably want a lot of partners with Shopify. But there's only one company in the sales and marketing CRM space that Shopify has partnered with to be able to invest in them, and that is in Klaviyo. So that's one kind of a simple moat. I wouldn't call it a moat in the sense that how Warren Buffett defines a moat, but I don't foresee how another company would be interested, or Shopify would be interested in putting money in another company that competes with Klaviyo, simply because it doesn't make any sense for them to do that. And then besides that, they have a ton of customers. It's very, very difficult to move. I mean, you used what do you use for email connections with your customers and consumers? Do you use something like a Substack or?
Uh,
I use a Substack personally.
Yeah.
yeah.
Okay.
And then
You
I'm just emailing or using Discord for most of my communication. So just
okay? So
using
take Discord as an example, or take Substack. It's technically very easy to move away from Discord and very easy to move away from Substack. There are alternatives, but damn, it's a lot of work. And given so many other things in your life, you're not going to change. Right? People get upset with, oh man, Substack is increasing the fee by 2% or 1%, or they're doing this, they're doing that. They never move out. The number of percentage of people that move out once they've got into something is very low. Technology has this sticky element to it because of the inertia, not so much from the fact that I don't want to do it. I've got so many other things in my life I have to do, and now this is going to cause another, certain amount of time to get done. I'm not doing it. Klaviyo, from a business standpoint, is very sticky that way. CRM is primarily your interface with customers, customer relationship management solutions. Once customers get used to it, your team gets used to it, nobody moves out of that.
Yeah.
Absolutely. And I was talking to Josh about this the other day, how I just got done building just a basic web page, and, considering on your note on Substack, moving in and out of the platform, you're also utilizing a trusted platform that when you see that email from Substack, you know that you can trust that email, you can trust a link instead of, random domain that you may or may not have heard of, that you may be cautious on, exploring further to get that information.
Yeah, well, and then the familiarity that's also built over time. I mean, you take so much for, even if there is mistakes that they make with Shopify, it's gonna take so many mistakes for them to make before someone actually transitions away. God, I know with like Microsoft Cloud services that they provide, not the same, it's not a CRM, but they have so many issues or outages and problems that they have with companies, but everyone's like, well, it was only down for 5 minutes and there's tons of issues, but it's so much hassle to move to someone else that even if the service is not stupendous and 100%, it's just there's only two other players you can go to. It's such a hassle. You're already familiar with what you're working with. Why would you move? That's one of the things that if you read like reviews, they're awful, but then when you think about why don't they move away, it's usually something correlated to that. I do want to ask you about this. I'm staring at the ticker now, and I've already forgotten how the company name, the KVYO, Clove. Is that what?
Javier.
Clavio. Is there any companies like Clavio that are really standing out to you right now that are piquing your interest or that have made it into your portfolio, or any future IPOs like Discord or maybe Stripe hits your technology background that you're excited about in the future?
Yeah, the companies that are piquing my interest, that are not yet IPO, coming in from the technology space, they're going to be quite a. So the thing is, you're not going to get any AI, pure play AI companies, at least for another 5 to 10 years, at least at the very minimum, right? At the minimum 5 years, most likely closer to 10 years. The average age of the company going IPO over the last 20 years have moved from about 5.7 years to 7.9 years. So that means companies are older, they're taking longer to go IPO. So any company started in the last 1 year, which is when truly the generative AI space has blossomed, is going to take another 5 to 10 years to come up. So I'm not looking at AI companies coming out for me in the next few years that are pure play AI. In the meanwhile, there are NVIDIA is an example, SMCI is an example, Palantir is an example. There are use a lot of AI in able. Like good written by one of the people that runs a venture firm called NFX. I don't know if you guys have ever heard of it. NFX is NFX. It's called Network Effects. NFX. The reason I know them is because the founder also started Trulia, which is a real estate technology company that he sold to Zillow. And written was there are multiple layers of the AI stack. There's the infrastructure layer at the bottom, and then there's the layer that allows you to be able to build learning algorithms and language learning mechanisms, language learning methods. And then above and beyond that, you have applications. There are a lot of companies on the application layer that are already public right now that can leverage AI to do a much better job of helping their business grow faster. Meta is an example of one company. To me, they're not just, they're building their own Llama LLM equivalent variant, but they're also using AI in a significant way to make their ads better, to serve up more relevant content for Instagram users, for example. Companies like that are on the application layer using AI, there are quite a few companies that I think would benefit a lot. HubSpot is another one. In terms of new IPOs, I was looking forward to, actually Visa had acquired a company called Plaid. Have you heard of that?
I am, but it's not gonna. I've heard. I'm familiar with the brand name, but I don't think I can recall what they do.
So if you go to a lot of the fintech companies like SoFi, or even a bank, or even any other third-party broker, and you want to connect your bank account to this new company to be able to transfer money, in the traditional place, you'll have to enter your account number, you'll have to enter your routing number, and then they put a small deposit of like 10 cents, 20 cents twice, and then they'll ask you to confirm it. Big pain, takes 3-4 days. With Plaid, you enter your user ID password, and it automatically connects literally within minutes or seconds, if you will. That's what Plaid does. So the infrastructure to help you connect accounts together, right? As one thing, that's one of the things that it does. Plaid was actually, it was supposed to be acquired by Visa, the company that provides you the infrastructure for being able to do payments. And then Visa said no, because FTC said, hey, what are you doing? You shouldn't be doing this. So Plaid, to me, more than Stripe, is a very interesting company for me to look about that investing them in if and when they go public, right? Stripe is going to be very richly valued when it comes out, and there's going to be a lot of hype on it. So usually the well-hyped stocks, for example, if you look at the class of 2020, 2021, there was a ton of IPO during that time. Airbnb, Snowflake, a little bit before that was Uber, DoorDash, Coupang. the valuations on all those companies was so rich. Even now, they're digesting their valuation, although their revenue has gone up nearly 3 times or 2 times compared to where they were before. Profitability is much better. Valuation matters. I think I wouldn't expect any of those companies to come with a low valuation. I would like a company with a medium to low down, like Symbotic, for example, came out as a SPAC. Valuation just cratered, got ignored, and then now I think it is on a rise mend. Look at a company that I really liked, which I think is going to take a little bit of time. There are two companies that I really like. They're not IPOs, but they're recent. Evolve is one, EVOLV. EVLV is a ticker symbol. EVLV. I really like the company. Good, strong play. They provide security for sports stadiums and events. So instead of you having to go through the TSA pre-check kind of an environment, you hold up your hand and you do a bunch of different stuff and you go through all the metal detector. These guys focus primarily on making sure that you get into events faster. So sports events, concerts, you can walk through very, very quickly, and they will detect certain things that they're looking for. They're not 100%. They don't detect any metal, but they detect guns. They are looking to detect knives. So schools are using them extensively to screen kids before they go into class and look for guns and things of that nature. EVLV is a ticker symbol. I like that company. I think it's going to take a little while. It's still small capish for me, so I'm not going to buy into it yet, but I like it a lot. I'm going to watch it for quite a while. And another company is ALUR. The ticker symbol is ALUR, which is a obesity company. So it's not perfectly in my technology space, but what they do is they give you a balloon. So you swallow a little pill, and it's a balloon that sits in your stomach, reduces the amount of food that you eat, and of course it later on passes by. It's primarily sold through doctors and practitioners to help people with obesity. Growing very well, revenue is solid. Again, got hammered. Just like it's going to be a while, people realize this company, and then it's going to start moving up into the right again. But it's going to take a while. Those are the ones that interest me quite a bit. The ones that have been beaten down quite a bit, but I'm going to wait and be patient for them to really prove over a tough period. And they're going to consolidate. It's going to be stage one consolidation for both of these stocks for quite a while. Their revenue is growth is extremely strong. Evolve has grown like 100%, literally every quarter over the last 3-4 quarters.
That's impressive. Okay. So, I mean, I'd have to look into those, but typically what I do with smaller companies like that is I tend to really overvalue that. Are they profitable? Is Evolve profitable? I mean, I'm going to have to do my own research, but
Evolve is not, neither is Allure, but I think they'll get there for a year. I think 2024 end, not 2023. So next year.
Quick. It's pretty quick. Yeah. That's great.
They're growing dramatically. They're growing really fast. And they have a combination of hardware and software. And they moved from a hardware only 30% margins, and now they have a combination of software, which is subscription software service. So the margins, the blended margin will grow up closer to the 40-50% range. The software comes in at an 80% margin range. The hardware comes in at a 20% margin range. So the blended, they'll go up a little bit more, I think. But strong company, good company. I think this is going to be a keeper, but it's going to take a while for them to prove itself out.
Yeah. It seems to be pretty common in the tech space where you kind of, I don't want to say give the hardware away for free, or you're giving away at a low margin, but the subscription service, the licensing services that these tech companies offer on their software, that seems to be the real money maker, the recurring revenue, the growth aspect to it.
Yeah, so if you look at, remember Peloton, that one gives me scares sometimes, but I wrote it all the way. I wrote it all the way up during the COVID boom, sold it early enough, luckily. But yeah, the hardware, draw them in with hardware, keep them with the high margin software for long, is a standard play for most of these tech companies, who are in the hardware kind of software space. Hardware is hard. There's a reason why it is that way. There are very few companies like the Nest and the Ring that can make money on hardware and do it at scale. That's only if everybody wants it. But a company like, for example, Evolve, where, you know, this is the schools, stadiums, maybe some offices where they need it, it's going to be tough to be able to sell a high margin hardware unit.
No, absolutely. I got two notes on that. The first is, Roku just got into that hardware business with the home security, the smart home stuff this last year. So that might be a interesting one to start looking at a put position for. And then the other one was, I'm pretty salty on Peloton. I remember reading an article in the journal. It was like right around December when they cut their subscription fees. And that's when I knew, okay, it is time to short this position. I was working at a value firm. I needed all my trades approved. And they looked at me like I was crazy whenever I suggested a tech company. So I'm still kicking myself to this day for not writing that one all the way down.
That one was a disaster in particular.